What you're about to hear will likely be studied years from now as the moment a long-standing financial relationship quietly began to unravel. While most people were focused on daily headlines, one of America's closest allies took a step that signals far more than a routine market adjustment. Japan, the largest foreign holder of U.S. government debt, has started pulling back. Not loudly, not with a press conference, but in a way that markets understand immediately. And when markets understand something before the public does, the consequences tend to arrive fast. This isn't about politics, and it isn't about speculation. It's about incentives, pressure, and survival. Japan is facing a collapsing currency, rising import costs, and an economic structure that cannot tolerate higher interest rates. In that environment, loyalty becomes secondary. What matters is defending the yen, and to do that, Japan has to sell dollars. That means selling US Treasuries, the very asset the world has treated as the ultimate safe haven for decades. If you want calm, research-driven breakdowns of events like this before they hit the evening news cycle, make sure you're subscribed. This channel exists for moments exactly like this, when the story is still forming, and understanding it early makes all the difference. The reason this matters so much is because the US Treasury market isn't just another market. It's the foundation beneath everything else. Mortgages, stock valuations, pension funds, and government spending all sit on top of it. When a major holder steps away, yields rise. When yields rise, pressure spreads outward, and once that process starts, it rarely stays contained. Japan isn't acting out of hostility. That's what makes this more serious. Hostile selling can be dismissed or managed politically. Forced selling cannot. Japan's debt-to-GDP ratio is extreme, and raising rates to defend the yen would destabilize its entire system. Selling treasuries becomes the only viable option. It's not a choice made lightly. It's a signal that the old arrangement no longer works for everyone involved. And here's where silver and the dollar quietly enter the picture. When confidence in government debt weakens, capital looks for alternatives. Historically, that means real assets, not promises, not paper claims, assets with limited supply. Gold gets the headlines, but silver sits at the intersection of money and industry. It's required for energy systems, electronics, defense, and emerging technologies. When monetary stress meets industrial demand, silver behaves very differently than most people expect. At the same time, the dollar faces a contradiction. To support the bond market, intervention becomes more likely. But intervention weakens the currency. Foreign holders see that risk first, not last. That's why this shift matters. It's not about one country. It's about a feedback loop that feeds on itself once trust starts to erode. Most people won't notice this until it shows up as higher borrowing costs, market volatility, or sudden moves in metals they weren't watching closely. By then, the narrative will already be set, but right now we're still early enough to understand what's forming and why it's forming. Before we go further, I want to hear from you. Are you seeing changes in bond yields, metals prices, or currency moves where you live? Drop a comment and share what you're noticing. And if this perspective helped clarify what's really happening, consider sharing it with someone who needs to see it before the story becomes obvious to everyone else. The next piece of the story is where the official explanation starts to fall apart. Publicly, Japan's actions are being described as routine currency stabilization. That phrase sounds calm, technical, almost reassuring. But in central banking language, it's a warning label. Currency stabilization only becomes necessary when confidence is already slipping. It asks what you say when the pressure is too visible to ignore, but still early enough to avoid panic. Japan's problem starts with the yen. Over the last few years, the yen has weakened steadily against the dollar. That weakness makes imports dramatically more expensive for a country that relies on foreign energy, food, and raw materials. Every drop in the yen raises domestic prices, compresses household spending, and forces policymakers into a corner. Defend the currency or preserve the economy. Japan cannot do both. Raising interest rates would normally support a currency, but Japan doesn't have that luxury. Its government debt is enormous, far beyond what higher rates would allow the system to carry. Even modest rate increases would cascade through government finances, corporate balance sheets, and household debt. So rate hikes are effectively off the table. That leaves one remaining tool: selling dollar reserves. And the largest dollar reserve Japan holds is U.S. government debt. This is where the story becomes uncomfortable for U.S. markets. Treasuries aren't just investments, they're collateral. They sit inside repurchase agreements, derivatives, pension structures, and global liquidity plumbing. When a large holder sells treasuries, it doesn't just change prices, it changes how much collateral exists in the system. And when collateral shrinks, leverage tightens everywhere at once. Markets notice this before headlines do. Yields don't drift higher randomly. They jump when buyers step away and sellers become price insensitive. That's what emergency selling looks like. It's not gradual, it's mechanical. Algorithms detect the flow, front-run it, and amplify the move. Suddenly, what began as a currency defense turns into a global repricing of risk. Mainstream commentary tends to isolate events. A bond auction here, a currency move there. But financial systems don't operate in isolation. They operate through feedback loops. Higher yields raise government borrowing costs. Higher borrowing costs pressure budgets. Budget pressure raises questions about sustainability. Those questions push more holders toward the exit, and every exit makes the next one easier. This is why Japan matters more than previous sellers. China reducing treasury holdings was framed as geopolitical strategy. It could be rationalized. Japan is different. Japan is embedded in the system. It followed the rules. It recycled trade surpluses into US debt for decades. When a participant like that is forced to sell, it signals structural stress, not strategic choice. As yields rise, the Federal Reserve faces a dilemma. Allow the market to clear at higher rates and risk slowing the economy sharply, or intervene to cap yields and stabilize the system. Intervention supports markets but weakens the dollar. That trade-off sits at the center of everything that follows. You can protect debt prices or protect purchasing power, but not both indefinitely. This is the backdrop against which silver becomes relevant. Not as a trade, not as a headline, but as a signal. When bond markets strain and currencies wobble, capital begins to reassess what is trusted and what is promised. Silver exists outside promises. It doesn't depend on policy credibility, and that's why it quietly responds before most people are paying attention. We're still in the phase where explanations sound technical and controlled. That won't last. As the mechanics continue to work through the system, the consequences become visible in places people can't ignore, and that's when reactions accelerate. To understand why this situation doesn't resolve itself quietly, you have to look beneath prices and headlines and into the structure holding everything together. Modern financial markets run on leverage and collateral. Debt isn't just borrowed and repaid. It's reused, rehypothecated, and layered across multiple transactions at the same time. US Treasuries sit at the center of that structure. They are treated as risk-free, interchangeable, and always liquid. That assumption is what allows the system to function at its current scale. When a major holder like Japan sells treasuries, the immediate effect is visible in yields. But the more important effect is invisible. Collateral disappears from the system. Banks and institutions that relied on those bonds to secure funding suddenly have less flexibility. To compensate, they reduce leverage, tighten lending, and hedge more aggressively. The tightening shows up as volatility across markets that appear unrelated on the surface. This is where algorithmic trading plays a role. Large flows don't move through markets quietly anymore. They're detected, modeled, and exploited in real time. When selling pressure hits treasuries, algorithms anticipate further weakness and position ahead of it. Futures are shorted, options hedges activate, market makers adjust risk parameters. What would have been a slow repricing decades ago becomes a rapid cascade. As yields rise, valuation models everywhere begin to shift. Equities are discounted against higher rates. Real estate financing becomes more expensive. Government interest expenses increase automatically. None of this requires new decisions or policy mistakes. It's mechanical. The system responds exactly as designed. And once those responses begin, reversing them becomes increasingly difficult without outside intervention. This is the point where confidence starts to matter more than numbers. Markets can absorb bad data. They struggle with uncertainty about rules. When participants begin to question whether treasuries will always be supported, behavior changes, duration shortens, liquidity dries up at the edges. Smaller shocks produce larger reactions. That's how instability grows without a single dramatic event. The Federal Reserve is aware of this dynamic. It's why central banks rarely speak plainly about stress in bond markets. Words alone can accelerate what they're trying to contain, but silence doesn't remove pressure. It only delays recognition, and delay increases the eventual response size when action becomes unavoidable. If yields climb far enough, intervention becomes the only option. The Fed can step in as a buyer of last resort, stabilizing prices and restoring collateral availability. But that support isn't free. It expands the money supply and weakens the currency. Foreign holders understand this trade-off clearly. They don't wait for official announcements. They adjust positioning as probabilities shift. This is where silver's role changes from theoretical to practical. Unlike bonds, it isn't someone else's liability. Unlike currencies, it can't be issued in response to stress. And unlike gold, it sits inside supply chains that cannot function without it. When confidence in financial promises erodes, assets that exist outside those promises gain relevance. Silver's market is small compared to bonds or currencies. That's why it moves differently. Capital doesn't need to be large to create outsized effects. A modest reallocation toward physical metal can strain supply quickly, especially when industrial demand is already high. This isn't speculation, it's arithmetic. At this stage, most participants still believe this is manageable. That belief is what keeps behavior anchored. But once enough, holders begin acting defensively, the system stops responding smoothly, it lurches. And when that happens, narratives change fast. We're approaching the point where the mechanics begin to overpower the messaging. When that line is crossed, reactions become reflexive rather than reasoned. And that's when the consequences people didn't prepare for start to arrive. History is the part most people underestimate, not because it's complicated, but because it's uncomfortable. Financial systems don't fail in new ways. They fail in familiar patterns that look obvious in hindsight and unbelievable while they're forming. The reason this moment matters is because it echoes those patterns with unsettling precision. In 1971, the United States closed the gold window. At the time, it was framed as a technical adjustment. Foreign governments were converting dollars into gold faster than the system could sustain. The official explanation focused on flexibility and modernization. The reality was simpler. Trust had eroded, and the math no longer worked. Once that trust broke, the system changed permanently. The dollar survived, but it never returned to what it had been. In 1985, the Plaza Accord forced a realignment of currencies to address growing imbalances. Japan complied. The yen strengthened, asset prices inflated, and what followed was a bubble that defined decades of stagnation. Again, the adjustment was presented as controlled and cooperative. The consequences unfolded slowly, then all at once. In 1997, a currency collapse in Thailand triggered a regional crisis that spread through Asia. It began quietly. Capital moved, pegs broke, liquidity vanished. And what followed wasn't just economic damage abroad. It nearly took down the global financial system when leveraged institutions in the West were caught on the wrong side of those moves. The problem wasn't ignorance, it was interconnectedness. In 2008, the failure didn't start with mortgages collapsing. It started with confidence in collateral evaporating. When counterparties stopped trusting what was posted as security, lending froze. Markets didn't wait for confirmation. They reacted instantly. The response required unprecedented intervention, and the costs were deferred into the future. Each of these episodes shares the same core sequence. Stress builds, official language minimizes it, market signals worsen, confidence breaks, intervention follows. The currency absorbs the shock. Wealth shifts, not evenly, but decisively. What makes the current situation different is scale and exhaustion. Tools that were once extraordinary are now routine. Balance sheets are already expanded. Rates have already been suppressed for years. The margin for error is thinner. When the next adjustment comes, it has less room to maneuver. This is why silver keeps reappearing in these moments, not because it's fashionable and not because it promises safety. It appears because it sits at the fault line between monetary trust and physical reality. During past monetary stress, the gold to silver ratio compressed sharply. Silver didn't move first, but when it moved fast. Supply couldn't respond in time. Demand didn't need to be perfect. It only needed to be urgent. History doesn't repeat word for word, but it rhymes with brutal consistency. Systems built on confidence work until they don't. And when they don't, the adjustment isn't negotiated. It's enforced by markets. We're now close enough to that point that past examples stop feeling academic. They begin to feel instructive. The question isn't whether pressure will ease. It's how the release expresses itself, and who is positioned to understand it while it's still unfolding. What comes at the end of cycles like this is never announced in advance. There's no press conference that declares the moment confidence finally tips. It shows up indirectly through behavior, through what people stop buying, through what they quietly start holding instead. By the time the conclusion feels obvious, the most important positioning has already happened. If Japan's exit from US debt continues, yields remain under pressure, and intervention becomes unavoidable, the dollar faces a slow but persistent dilemma. Support the system and weaken the currency, or protect the currency and allow the system to strain. Historically, policymakers choose stability first. That choice buys time, but it changes the value of money. Purchasing power erodes quietly, unevenly, and often faster than expected. This is where outcomes begin to diverge. Those who treat money as something static experience the adjustment as loss. Savings buy less. Income lags prices. Volatility feels like chaos. Others recognize that monetary systems are fluid. They adapt, not by predicting exact prices or dates, but by understanding direction and probability. Silver sits in that second category of awareness, not because it guarantees protection, but because it reflects stress early. Its market doesn't require consensus to move. It only requires enough pressure to overwhelm limited supply. When monetary confidence weakens at the same time, industrial demand remains firm, silver stops behaving like a commodity and starts behaving like a signal. At that stage, reactions tend to become emotional. Media narratives swing from dismissal to urgency. Price moves accelerate, pullbacks become sharper, and psychology replaces patience. That's when most people feel compelled to act, even though the most favorable conditions existed earlier, when uncertainty was higher, but prices were quieter. The final phase is never orderly. Systems that unwind under pressure rarely provide clean exits. They overshoot, correct, and overshoot again. Those movements aren't designed to reward discipline. They test it, and they tend to transfer wealth from those reacting late to those who understood the structure early. This isn't about fear. It's about pattern recognition. Debt-heavy systems eventually lean on their currencies. When they do, tangible assets reprice relative to money, not because they changed, but because the unit measuring them did. That adjustment doesn't announce itself. It reveals itself over time. If you followed this far, you're already doing the most important part. Paying attention before the narrative hardens. I'm curious what you're seeing. Are you noticing shifts in rates, metals, or confidence where you are? Share your perspective in the comments. These conversations matter more than headlines right now. And if this helped clarify what's forming beneath the surface, consider sharing it with someone who's still relying on the official explanation. Most people don't get the chance to see these patterns early. This is one of those moments. The transition doesn't happen overnight, and it doesn't happen quietly forever either. It unfolds step by step until one day the outcome feels inevitable. By then, the only real question is whether you understood what was happening, while there was still time to think clearly about it.